The first part of our ACE-1 orientation presentation will explain the relationships between Prime Incorporated and its Success Leasing Associates. There's 3 business entities in the makeup of Success Leasing. First is Prime Incorporated Motor Carrier. They provide freight to haul, trailers to pull, and logistics to plan and coordinate each load. Second is Success Leasing. They handle your truck equipment. The third entity is the independent contractor who truly runs the business. The first part of this presentation will examine financial examples of how Success Leasing's program works and how the different revenue streams come together to make for a profitable business. The first item to discuss is budgeting. There are 3 ways to obtain a tractor. You can lease one from Success Leasing, you can purchase one from an outside source, or lease a tractor from an outside source, and as an independent contractor, you can lease it to Prime. If you lease a tractor from Success Leasing, there's a $1,500 performance bond that you are required to post. To fund the bond, Prime will deduct $30 per week for the next 50 weeks. Once your lease is up, your bond is treated in the same regard as a deposit of an apartment or rental house. If there's damages to the tractor, your bond will apply towards those costs. If there's no damage to the tractor, your bond is returned to you in full. The performance bond is subject to a $220 credit after you've completed the ACE-2 class. We highly recommend taking this course 4 to 6 weeks once your lease starts. This will help evaluate your business to date. Most successful and profitable operators understand that they're running a business and that there's a proven formula to it. Whether it's retail or selling a product, when you're selling your services hauling freight down the highway, a solid business plan formula is essential. The volume of your work multiplied by the rate of your work generates revenue. Out of those revenues are expenses. By subtracting your operating expenses from your earned revenue, you'll show a profit or a loss on your business. Remember, rate times miles equals revenue minus expenses equals profit. A frustrating part of this industry is it's impossible to control freight rates. Rates are determined by supply and demand, but you do have control over how much volume of work you want to perform, efficiency of time management, efficiency of your hours of service, efficiency of fuel mileage, plus maintenance costs all play a major role in your business's profitability. Here's an example that shows a solo driver averaging 2,500 miles per week. If you're thinking about becoming a team driver, then you can double these numbers to understand how the business model works. Let's look at how to average 2,500 miles per week for a solo driver. Remember, to average 2,500 miles per week, it takes more than 2,500 miles because you'll have time off from work. You could drive 2,300 miles the first week, 3,300 the second week, 2,500 the third week, and so on. The point is that over the course of those 4 weeks, you've got to average 2,500 miles. After those 4 weeks, you decide to take 2 weeks off. Remember that you're not required to work miles. You have total control over how much you want to drive and earn. You have control over your days off and how many weeks you spend out on the road. This example is simply to show you how to average 2,500 miles per week. If you drive more miles with less time off, you could easily average a higher rate of miles per week. In this financial example, we'll use 2,500 miles per week for a full year. That would be a total of 130,000 miles driven in that year. Those miles are inclusive to dispatch authorized miles. Driving your truck for personal use or out of route is not included in this example. Rate settings are based upon supply and demand, supply of freight, and the amount of trucks available to haul. If the marketplace is saturated with trucks and there's less freight to go around, rates will reflect that in a lower number. If there's more freight than available trucks, shippers have to compete with other shippers to hire available trucks. In this case, rates are likely to be higher. Our next example will reflect a $1.02 per mile revenue. Take note that $1.02 a mile is the minimum guaranteed amount that Prime offers for flatbed and reefer, and $1.01 for tankers. Earlier, you were given a handout titled The Deal. On page 14, you'll see a list of revenue items. The top part of page 14 identifies reconcilable revenue, and the bottom identifies non-reconcilable revenue. Reconcilable revenue applies to the $1.02 per mile guarantee. The bottom part of the deal is in addition to the guarantee. It is mathematically impossible to earn just $1.02. It's simply a minimum guarantee amount for those earnings. The good news is there's no maximum earnings cap, only a minimum guarantee. For the sake of this example, we're going to use this $2 number. In this example, guaranteed revenue is based upon 100,000 miles of dispatched authorized miles. Remember, that means miles dispatched. Personal miles are not covered. However, it does include deadheading to your load pick. As you see in parentheses, HHG is Household Movers Guide. That's a standard of rating. For every 100,000 miles, including empty and loaded, Prime guarantees a minimum of $102,000 in reconciled revenue. Refer back to page 14 of the deal at the top of the page for clarification. If you take $102,000 and divide it by 100,000 miles, you'll see that it totals $1.02 per mile. It won't go under that amount because of the Prime guarantee. Once you complete your 100,000 miles driven, you restart to the next reconciliation period. To be clear, this guarantee is not for just the first 100,000 miles you drive both empty and loaded, but every 100,000 miles thereafter until you complete a lease. Once you complete a lease, you move on to the next 100,000 miles driven. Let's recap how the Prime guarantee works. The guarantee is based upon 100,000 miles driven, both empty and loaded, household guided miles. The guarantee is based off a cumulative average to date. There could be a single load under $1.02. There could be a week that averages below $1.02. The guarantee is over the course of 100,000 miles. If you're under that amount for the 100,000 miles driven, your guarantee kicks in. Remember, your miles have to be authorized dispatch miles, not odometer miles driven. Let's summarize. An independent contractor drives 100,000 miles and generates $100,000 in reconciled freight revenue. Well, that's $2,000 under the guarantee. How does that extra $2,000 get paid to you? It actually gets paid to you as you go, automatically as an advance. At the end of 100,000 miles, you've actually been paid $102,000. The extra $2,000 shows up as an advance until you complete that 100,000 miles. Once the 100,000 miles has been completed, the $2,000 becomes earnings. It's not a repayable debt. If you terminate a lease early before completing 100,000 miles, that $2,000 paid to you remains as an advance and must be repaid. Let's say you've completed a lease and you've gone through 2.5 reconciliations. That means 250,000 miles on the truck and 50,000 miles on the last piece of reconciliation. If there's an advance of guarantee, that will become earnings as well. How do you make your guaranteed earnings? 1. Complete 100,000 miles driven. 2. By completing the lease. In week 1, your gross earnings are $1 per mile. Prime will advance you 2 cents per mile, raising your earnings to $1.02 per mile. Week 2, your gross earnings are $1.04 per mile. Prime will recover the advance of the 2 cents per mile, stabilizing your earnings to $1.02. In the first week you were paid $1.02. In week 2, you were paid $1.02. In week 3, your gross earnings are $1.10 per mile. The operator will receive the full $1.10 earnings. The average for the 3-week period is $1.05. but you're above the prime guarantee with no advances towards the guarantee. In week 4, the gross earnings are 96 cents per mile, which is below the guarantee. The operator will see a 96 per mile earnings. That's because the average of the 4-week period is $1.02.50. Remember, the guarantee is based on an average, not per load, not per week, but an average over the course of 100,000 miles. So far, our average is $1.02.50. At week 5, your gross earnings are $1.26 per mile. In this case, the driver would be paid the $1.26, and the 5-week average is $1.07. Now that we understand where the $1.02 comes from, we're going to continue to use this number for the remainder of this financial example. Multiply $1.02 by 130,000 miles driven. That represents 2,500 miles per week average over the course of a year. This operator has generated $132,600 in gross earnings. Items like fuel surcharge, detention, and other operating charges are not included in this figure. Keep in mind that the $1.02 is just for this example only. Out of the gross income, expenses are deducted. There are 2 types of expenses. The first expense is called fixed expenses. This expense is not controllable. It covers items such as your lease payment. You need to know what your fixed expenses are so you'll know how much revenue you need to generate to pay for them. It's critical that you focus on your variable costs because they're controllable, and a contractor can actually determine the outcome based by the mile, by the hour, by the week, the driver's efficiencies, and time management. The largest cost will be the lease payment of your tractor. This example shows $1,020, which includes new trucks, used trucks, refrigerated, flatbed, and tanker trucks. Across the board, that's the average cost of lease to date. If your weekly payment was $1,020, after 52 weeks, you would have paid $53,040 in total. There's 3 funds that need to be established to make sure you had the money to pay for them once those expenses arrive. The first one is a tire fund. When the time comes for new tires, you'll have saved for that day and have the money to cover it. Prime will hold back 2 cents a mile for you. The money is put into your tire account. At the end of your lease, if there's any money left in the tire fund, the balance is yours to keep based upon certain tire specifications according to the lease agreement. IFTA stands for International Fuel Tax Agreement. You'll learn more about fuel taxes in upcoming courses, but for now, this will help you understand where this money goes and what it's paying for. You'll set aside 2 cents per gallon for IFTA. This is to pay for surcharges from different states that you drive through. Here's an example. You fuel up in Missouri at a cost of 17 cents per gallon. That money goes to the Missouri state fuel tax. On that same trip, you drive through Illinois. Then you refuel in Indiana. Since you drove through Illinois, they're going to want their fuel tax too. So the 2 cents you saved up will pay for the Illinois fuel tax. The 2 cents a mile is used to pay for whatever state you drove in but did not purchase fuel in. This will be covered in more detail later in the presentation. If you don't use all of the IFTA money in your account, the balance will be refunded back to you. The mileage fee is a variable portion of your lease payment. The more miles you run, the more revenue you generate. The less miles you drive, the less revenue you earn. The 5.5 cent rate will decrease the longer you're in it. If you add the 2.5 cent tire fund, 2 cent IFTA fund, and 5.5 cent mileage fee, you'll have a total of 10 cents. If you drive 130,000 miles, as this example shows, you would have paid out $13,000. Remember that the tire fund is your money. IFTA pays for fuel taxes, and the mileage fees are an expense to the truck and should be considered when filing your taxes. Fuel is our number 1 and largest variable expense. In this example, we continue to use the 130,000 miles driven. and 7 miles per gallon of fuel. Prime's current fleet average is 7.3 miles per gallon, which is a very respectable rate for a fleet Prime's size. Take 130,000 miles driven and divide it by 7 miles per gallon, and you get a total of 18,571 gallons of fuel burned. Obviously, that's a large number. Take the 18,571 gallons of fuel and multiply it by $1. You might be wondering where you're going to buy fuel for $1 a gallon. We'll discuss fuel surcharges and how they work soon. But before we do that, let's take the $1 a gallon multiplied by $1 for a total of $18,571. If you take the fuel bill and subtract the fuel surcharge, you'll have $1 per gallon left over. Now let's discuss the fuel surcharge program. Fuel is without question the highest controllable cost we have. Our fuel optimization software, commonly known as Macro 27, will make a huge impact in maximizing your fuel buying power and the utilization of our fleet discount program. We'll go into Macro 27 details later on the proper usage to maximize your earnings. The largest impact you can make to lower fuel surcharges is to use less gallons of fuel. If Truck 1 receives $500 in fuel surcharges and Truck 2 receives the same surcharge, the truck that burns the least amount of gallons is more profitable. Let's say Truck 1 burns 500 gallons and Truck 2 burns 200 gallons of fuel to deliver the same load and miles. Both have the same amount of miles driven, but Truck 2 has better fuel economy and therefore pays much less out of pocket for fuel. Here's some fuel surcharge examples. Prime uses a true ComData of purchases. To generate a fleet average, every time you swipe your ComData card to pay for fuel or request a fuel purchase order, Prime keeps track of those numbers to make sure that they have a true average. Prime subtracts 99 cents from the calculated average, then divides that number by 7 miles per gallon. To summarize, Prime takes the fleet average ticket minus 99 cents divided by 7, provided that you purchase fuel at or below the fleet average ticket and get at least 7 miles per gallon. You should never pay more than 99 cents per gallon. If you get 8 miles or higher per gallon, then you'll pay even less. Let's assume that the fleet average ticket was $4.10 a gallon. Then take out 99 cents, which leaves a balance of $3.11. Now take 311 and divide it by 7 miles per gallon. That equals 44.5 cents per mile. For the sake of this example, let's say that you have 1,000 miles dispatched. 1,000 miles multiplied by 44.5 cents, you'll receive line haul plus $445 in fuel surcharge. Let's do the math in reverse. If you take 7 miles per gallon and we receive 44.5 cents per mile, that means you're generating $3.11 in revenue for every 7 miles. You've spent $4.10. Remember, if you drive 7 miles, you'll buy 1 gallon of fuel. Here's how much the fuel actually costs you. The fleet average is $4.10 in our example. So if you drive 7 miles, you'll buy 1 gallon of fuel. During that time, you've made 44.5 cents per mile extra. If you spent $4.10 to drive 7 miles, you've earned $3.11 during those 7 miles. You have out-of-pocket costs of 99 cents. Fleet average ticket minus 99 cents divided by 7, you'll see that the math in reverse is the same. As long as you buy fuel within the fleet average ticket and get at least 7 miles per gallon, your out-of-pocket costs should not exceed 99 cents. To find fuel at the cheapest locations, you should consider state taxes and Prime's volume discounts. You'll find those by using Macro 27. In this example, you'll see a driver getting 5 miles per gallon. The 44.5 cent surcharge still remains the same. It's based upon fleet average minus 99 cents divided by 7. The 44.5 cent surcharge still remains the same. It's based upon fleet average minus 99 cents divided by 7. Even though the driver is averaging 5 miles per gallon, the fuel charge is still based upon 7. At 2,700 miles driven for 1 month, using 4 weeks, that's 10,800 miles driven. The operator averages 5 miles per gallon, so his fuel purchase total is 2,160 gallons of fuel at 5 miles per gallon. It still costs $4.10 per gallon. If you take 44.5 cents per mile and multiply it by 5 miles per gallon, it shows an earnings of $2.22.5. You spend $4.10 and earn $2.22.5. Instead of spending $1.20 per gallon, this operator spent $1.90 per gallon. Let's look at that $1.90 figure. At 2,160 gallons of fuel, that's $4,104 for the month to operate this vehicle. Let's say that the same truck is getting 7.5 miles per gallon. If it ran 2,700 miles per week for 4 weeks, it's still the same 10,800 miles driven as the last example. But by averaging 7.5 miles per gallon, he would have purchased 1,440 gallons of fuel versus 2,160 gallons of fuel for the same amount of work if he averaged only 5 miles per gallon. At 7.5 cents per gallon, this operator spends $4.10. Remember, that cost of fuel remains the same whether you get 5 miles or 7.5 miles per gallon. The cost per gallon is still $4.10. In 7.5 miles, that operator spent $4.10. Add 44.5 cents per mile extra for fuel surcharge. In 7.5 miles, the operator earned $3.30. If you subtract the $3.30 from $4.10, you're at 80 cents a gallon. 80 cents per gallon times the 1,440 gallons of fuel is $1,152 in a fuel bill. The previous example of 5 miles per gallon with the same amount was over $3,000. Where does that extra savings go? The answer, into your account. Now we move on to maintenance. Our fleet average for maintenance is 1.8 cents per mile. This is calculated on the basis of normal wear and tear, plus preventive maintenance. It includes oil changes, belts, hoses, fuel filter changes, and basic routine maintenance. Keep in mind that maintenance costs will increase throughout the lease. You might experience 1 CPM the first year and 3 CPM the third year. It's very important to budget accordingly. To recap Part 1, we have revenue generations of $132,600. It's based upon taking a 2,500 miles solo per week for 52 weeks at 99 cents per mile. We used a $1,020 per week truck payment, bringing the yearly total to $53,040. The funding accounts of the 2-cent IFTA, 2.5-cent tire fund, and the 5.5-cent mileage charge equals 10 cents per mile, equals $13,000. Next, we use fuel at 7 miles per gallon. We use fuel at 99 cents per gallon after surcharges, and this leaves a fuel bill of $18,385. If that operator averaged 8 or 8.5 miles per gallon, the operator would have saved $10,000 to $15,000, which goes to the operator. Finally, using Prime's maintenance costs at 1.8 cents per mile, provided the operator generated 130,000 miles, means 130,000 miles multiplied by 1.8 cents per mile totals $2,340. So that's a profit of $46,000. Remember, we used $1.02 generating 2,500 miles per week and using less than fleet average of 7 miles per gallon. If this operator averaged 8.5 miles per gallon, the $18,571 in savings would be in addition to the $46,000 figure. A couple hundred extra miles per week at $1.02 could add up to several $1,000s to your bottom line. In today's marketplace, most of our drivers are averaging 20 cents higher than this, which is around $26,000 more on top of the $46,000 figure. Proceed to Part 2.